We are back now with Brian Belski, Chief Investment Strategist of BMO Capital Markets. Brian, let's keep it rolling here, and we'll go to the U.S. And you and your team, you're still bullish, and you don't see any real trouble on the economic horizon or market horizon for U.S. stocks. Why is that?
Well, we don't, because at the end of the day, we live by a couple simple rules, one of which is stocks lead earnings, which lead the economy. Stocks lead earnings, which lead the economy. I think too many investors have focused on the macro, and they've been wrong. And we're still waiting for this mythical recession to happen at some point. We're still too focused on the Fed, and now we're way too focused on politics and tariffs and all this kind of stuff and noise, where, again, control what you control, can control. That's lesson number two. And how you do that, Mark, is by really great assets from a stock picking perspective, with great company managements, great products or services, with reasonable and or achievable fundamental results, and a longer term track record of performance from a fundamental perspective. And that's how we manage portfolios in our career.
And given some of the uncertainty, some of the expected volatility, you and your team are pointing to dividend growers. Could you expand on that?
So in our 13 years at BMO, we've talked a lot about dividend growth, and Canadian investors love dividends, we know, because of their lineage from the UK. Especially UK investors are great dividend investors. So the key thing that we've tried to communicate through our entire career, but more succinctly during our 13 years at BMO, is it's not about buying a company that pays a high dividend. It's about buying a company, that grows the dividend over time, that may be growing the dividend faster than the market, and or has a higher yield. Those are the three kind of points to dividend investing. And we put our money where our mouth is in terms of how we run that specific methodology. We run a U.S. dividend growth portfolio and a North American dividend growth portfolio for our great wealth management team in both the U.S. and Canada. And both portfolios outperformed last year their respective benchmarks. Here's why. Because the majority of the portfolio are names that have never cut the dividend, at least the last 10 years, that have cash flow yields above the dividend yields above the market, and have positive earnings. We want to buy that total return in terms of fundamentally. But then there's also other parts of the portfolio that are growing the dividends more than the market. And then some, like 10% of the portfolio, that have yields above the market. People are shocked to understand and see that the majority of the portfolio is not high yield. And we've proven through time is that you don't want to depend on yield, you want to depend on dividend growth.
Now, Brian, with these with dividend growth stocks, your colleagues have done an interesting study, did some research going back to 1990 when yields are going up, and how dividend growth stocks perform. What did they find?
Well, they find that from a perspective of when yields are going up, it's a great way to have equity income through dividend growth, and that provides this type of yield. So from a yield investor, it's not just about buying bonds. You can actually have a great total return and a consistent return, especially relative to equities and in the market overall, in good times and in bad, to have more consistent performance by owning dividend growth, meaning equity income growth.
And how do you and your team go about screening for these kinds of stocks?
Well, it's not about screening. It is to some degree, but we start with looking for those companies that over the last 10 years have never cut the dividend, and then we also parcel it out by cash flow yields above the dividend yields above the market, and then positive earnings. That's where we start there. So in our official portfolio, 60% of the portfolios are always those names. Then, depending upon whether or not we believe as a group, if bond yields are going up or down, we take the remaining 40% of the portfolio, Mark, and decide whether or not we want to be in those areas that are growing the dividend more than the market, may have yields less than the market. Let's say like an Apple or even Microsoft would be in that in dividend growth category, believe it or not. And then on the high yield side, in Canada, it's names like, TELUS or some of the REITs, or even some of the banks. But in the United States, it's AT&T, Verizon, Comcast, Disney, those types of names that have higher yields than the market, that may not be growing fundamentally, but in terms of yield, they have higher yields.
And lastly, Brian, another idea that you're bringing us is to have a focus on discretionary stocks. You think there's going to be a turnaround there. Why is that?
We do, and it fits kind of what we're thinking about the Magnificent Seven. Now, the Magnificent Seven has three sectors, believe it or not: technology, communications, services, and discretionary. Your question specifically is consumer discretionary. And two out of the seven, Mag 7, are in discretionary, namely Amazon and Tesla. We're advising our clients to market weight those two stocks, meaning a barbell on one side is Tesla and Amazon, and on the other side of the barbell are true discretionary names, meaning the Lulus, the Marriotts of the world, Home Depot, TJ Maxx. That's where we are overweight in our portfolios. That's where we see more fundamental strength as a portfolio manager, have high tracking error there on the consumer discretionary side versus being more neutral and continue to enjoy what Tesla and Amazon are doing to the portfolio, but we want to be bigger in those other names.
Always great to see you, Brian. Thanks as usual for your time.
Thank you very much.